Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 5 of my Paths to the Corner Office 2025 to 2026 series where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topics. First, role of blockchain in improving banking security. Second, UPI and the revolution of digital payments in India. Role of blockchain in improving banking security. Blockchain technology has emerged as one of the most transformative innovations in the financial sector. Designed originally to support cryptocurrencies, blockchain has now found significant applications in banking due to its features such as decentralization, transparency, immutability, cryptographic security, and distributed consensus mechanisms. As banks face increasing cybersecurity threats, fraud, data manipulation, and operational risks, blockchain provides powerful tools to enhance security and trust in the banking ecosystem. At the same time, the adoption of blockchain is not without challenges, including scalability, regulatory issues, cost implications, and technical complexities. Understanding both the benefits and risks is essential for evaluating blockchain's role in strengthening banking security. Opportunities and positive impacts. Pros and arguments for blockchain in banking security. First, enhance data integrity and immutability. Blockchain ensures that once data is added to the ledger, it cannot be easily altered or deleted. This immutability reduces the risk of data tampering, insider fraud, and manipulation of transaction records. Banks can maintain more secure and trustworthy audit trails. Second, strong cryptographic protection. Blockchain transactions are secured using advanced cryptographic algorithms, making unauthorized access extremely difficult. Sensitive financial data, if stored on blockchain or verified using blockchain signatures, becomes more resistant to cyber attack and hacking attempts. Third, decentralized storage eliminates single points of failure. Traditional banking systems depend on centralized databases, which can be vulnerable to targeted attacks. Blockchain distributes data across multiple nodes, ensuring that even if one node is compromised, the entire system remains secure and operational. Fourth, improved fraud detection and prevention. Blockchain provides real time visibility of transactions. Every participant sees the same version of the ledger, making it nearly impossible to execute fraudulent transactions without detection. This is particularly useful in preventing credit card fraud, identity theft, and unauthorized fund transfers. Fifth, secure digital identity management. Banks can use blockchain-based identity systems to authenticate customers securely. Such decentralized identity solutions reduce reliance on vulnerable password systems and protect customers from identity theft. 6. Safer cross-border payments. Blockchain enables transparent, tamper-proof, and international transactions. This significantly reduces risks related to correspondent banking fraud, data interception, and settlement delays. 7. Efficient KYC and AML processes. Blockchain allows banks to share verified KYC data across institutions, reducing duplication. This improves security and reduces errors in customer onboarding while enhancing compliance with AML regulations through transparent tracking. 8. Transparent and traceable transactions. Every transaction is traceable from origin to completion. This transparency prevents fraud, reduces disputes, and makes it easier for regulators and auditors to verify the authenticity of banking operations. Challenges and negative aspects. Cons and arguments against blockchain adoption. Despite its strong security features, blockchain introduces several challenges and risks. First, high implementation cost and technical complexity. Adopting blockchain requires new infrastructure, skilled personnel, and system integration. The cost of migrating from legacy systems can be extremely high, especially for large banks. Second, scalability issues. Public blockchains, in particular, can process only a limited number of transactions per second. This can be a major barrier for banks that millions of transactions daily. Third, regulatory and legal uncertainties. Blockchain's decentralized nature complicates enforcement of regulation. Issues like data privacy, especially under GDPR-like laws, jurisdictional disputes, and accountability need clarity. Fourth, resistance from industry stakeholders. Banks with deeply embedded legacy systems may resist shifting to blockchain due to concerns over disruption, job changes, and large-scale system redesign. Fifth, vulnerability through endpoints. While blockchain itself is secure, vulnerabilities may arise at user interfaces, wallets, smart contracts, or integration point where hackers may exploit loopholes. Six, data privacy concerns in transparent blockchains. In certain blockchains, transaction data is visible to all participants, raising privacy issues. Even with encryption, metadata may reveal sensitive information. 7. Energy consumption issues. Some blockchain consensus mechanisms, like proof of work, require high computational energy. Although newer systems like proof of stake reduce this burden, sustainability concerns remain. 8. Fragmentation and interoperability changes. With multiple platforms emerging, interoperability across banks and institutions become difficult. Lack of uniform standards can hinder secure communication and data flow. Arguments in favor of blockchain's use in banking security. First, superior to traditional security models. Blockchain's distributed and cryptographic nature provides stronger protection than conventional databases, making it ideal for high value financial transactions. 2. Enhances trust and transparency in operations. Both customers and regulators benefit from clear tamper-proof records. This strengthens trust in the banking system, especially in areas prone to fraud. 3. Supports government and regulatory initiatives as central banks explore CBDCs, central bank digital currencies, and regulators push for digital compliance. Blockchain integrates well with future frameworks. 4. Reduce operational costs in the long run. Although initial investment is high, blockchain reduces costs associated with fraud, reconciliation, KYC duplication, and manual verification. Arguments against blockchain adoption. First, not suitable for all banking operations. Some banking processes require speed and flexibility that blockchain cannot yet deliver. Real-time high-volume retail transactions may not scale well. Second, requires significant cultural and organizational change. Employees and management must adapt to new workflows, which can be disruptive and time-consuming. Balanced evaluation. The role of blockchain in improving banking security is both transformative and complex. On one hand, blockchain offers unparalleled security features, including immutability, transparency, cryptographic protection, and decentralization, which significantly reduce cyber risks, fraud, and data tampering. It strengthens cross-border payments, enhances KYC or AML compliance, and ensures secure identity verification. On the other hand, blockchain adoption introduces new challenges such as high costs, scalability issues, regulatory ambiguity, technical complexity, and organizational resistance. While blockchain enhances security, it is not a complete solution. It must be integrated with cybersecurity measures like regulatory oversight and secure interfaces. Most experts believe that blockchain will not replace traditional banking systems entirely but will work alongside existing systems to enhance their security, efficiency, and transparency. Hybrid models combining blockchain with AI, cloud solutions, and secure databases are likely to become the norm. Conclusion: blockchain technology has the potential to revolutionize banking security by providing tamper-proof records, strong cryptographic protection, decentralized data storage, and transparent transaction processing. It enhances fraud detection, strengthens compliance, and supports secure digital identity management. However, blockchain adoption is not without barriers. High costs, regulatory challenges, scalability issues, privacy concerns, and technological immaturity must be overcome for widespread implementation. A balanced approach is essential. Banks must adopt blockchain selectively, focusing on areas where it offers clear security advantages. Collaboration between banks, regulators, and technology providers will be crucial to establish common standards. ensure interoperability, and address legal concerns. Ultimately, blockchain will serve as a powerful enabler of secure, trustworthy, and efficient banking, augmenting traditional systems rather than replacing them entirely. Banks that integrate blockchain thoughtfully will enjoy stronger security and improved customer trust and long-term competitive advantage in an increasingly digitalized financial landscape. UPI and the revolution of digital payments in India. Unified Payments Interface has transformed India's digital payment ecosystem in an unprecedented way. Launched by the National Payments Corporation of India, UPI has become the backbone of everyday transactions, enabling instant bank-to-bank transfers through mobile devices. From small kirana shops to multi-chain retail outlets and from street vendors to large corporates, UPI has de- de- democratized digital finance in a manner rarely seen worldwide. While it is widely celebrated for its convenience and inclusiveness, it also brings challenges regarding security, infrastructure, and financial viability of stakeholders. A balanced evaluation reveals that UPI is not just a payment tool but a catalyst reshaping India's socio-economic landscape. Pros and positives and arguments in favor of UPI. One of the biggest advantages of UPI is its instant and seamless fund transfer capability. Transactions between bank accounts occur in real time without the need for traditional details like IFSC, account number, or OTP verification. This ease has made payments effortless for millions. Another positive aspect is cost effectiveness. UPI transactions are free for customers and extremely cheap for banks, making it accessible even for low income users. Unlike card payments, merchants do not need expensive POS machines. A simple QR code suffices. UPI has significantly boosted financial inclusion. People in rural and semi-urban areas who previously avoided digital payments due to complexity now use UPI through simple apps like PhonePe, Google Pay, Paytm, and Bheem. Even small vendors who accept UPI payments report increased sales because customers are more willing to buy without worrying about cash availability. Another major advantage is enhanced transparency in the economy. Cash transactions often remain unreported, but UPI creates an auditable trail, benefiting taxation and reducing black money dependence. The system also encourages cashless behavior, easing the burden of currency printing, handling, and logistics. UPI is also praised for technological innovation. Features like UPI Lite, autopay for recurring payments, and interoperability across banks and apps showcase India's leadership in digital public infrastructure. The success of UPI has become a global reference model, with several countries collaborating with India to replicate similar systems. Cons and negatives and arguments against UPI. Despite its massive success, UPI has its own shortcomings. A major concern is cybersecurity and fraud. As usages has grown, so have digital scams, phishing attempts, and fraudulent apps. Many users lack awareness of safe digital habits, making them vulnerable. Another negative aspect is dependence on smartphones and internet connectivity, which restricts usage in areas with poor network coverage. Although UPI has simplified payments, digital literacy remains a barrier. Banks also face challenges because UPI generates little or no revenue. High transaction volumes strain banking servers and systems, requiring heavy investments in transactions without proportionate financial returns. Some bankers argue with the zero MDR merchant discount rate policies are sustainable and may affect long-term viability. Another issue is service disruptions. At peak times, banks often experience technical downtimes, leading to failed or pending transactions. This affects user trust and sometimes forces customers back to crash. There is also the concern of market domination by a few large private players. Apps like Google Pay and PhonePe collectively command a major share of UPI transactions, creating dependence on a few platforms instead of broad market competition. This concentration raises long term questions about data privacy and competitive neutrality. In addition, digital over-dependence comes with risks. In case of power outages, server failures, or mobile battery issues, users may face difficulty in making payments, a limitation not seen with cash. Balanced comparison, a nuanced view. UPI must be understood not as purely positive or negative, but as a complex innovation that brings both empowerment and challenges. While it has democratized payments, the infrastructure supporting is still evolving. The convenience it offers has no parallel. Even small value transactions can be completed instantly, something that was impossible with earlier modes like NEFT or debit cards. At the same time, the more India shifts to digital payments, the more robust systems and cybersecurity frameworks must become. UPI also stands at an interesting intersection between public good and commercial viability. For customers and merchants, it is nearly perfect, free, fast, secure, and easy. But banks and payment service providers struggle with the cost of burden maintaining systems capable of handling billions of transactions. Policymakers must balance the public utility of nature of UPI with the need to maintain banking sector sustainability. The revolution sparked by UPI has influenced behavioral and economic patterns. The sheer convenience has created a generation that prefers digital transactions over cash. Yet, this may impact traditional banking challenge like branches and ATMs reducing their relevance, but also putting pressure on banks to invest more in technology. In rural India, UPI simplicity has helped people integrate into formal banking, but digital literacy gaps can lead to misuse or fraud. Thus, awareness campaigns and customer education must grow alongside technological expansion. Arguments for UPI enables fast, secure cashless payments accessible to all, reduces reliance on physical cash and improves transparency, encourages innovation and strengthens India's position as a digital leader, helps small businesses grow by enabling easy payments, improves financial inclusion at scale. Arguments against UPI rising cyber frauds and data security concerns. Zero MDR makes it financially unsustainable for banks. Heavy dependence on digital infrastructure may cause disruptions. Market dominance by a few players risks long term neutrality. Limited accessibility in poor network or low digital literacy areas. Conclusion Balanced perspective. UPI stands as one of India's greatest financial innovations, reshaping how the country transacts and interacts with money. Its impact is undeniable, empowering millions who were previously outside the digital economy, simplifying payments, improving transparency, and making India a global pioneer in digital public infrastructure. The system strengths far outweigh its drawbacks, especially in terms of accessibility and convenience. However, a mature evaluation reveals that challenges persist. Cybersecurity threats, infrastructure constraints, financial viability for banks, and digital literacy are areas that require continuous attention. For India, the future of UPI appears promising, but its sustained success will depend on addressing these underlying issues through stronger regulation, bank incentives, improved technology, and enhanced customer awareness. UPI Ultimately, UPI is not just a digital payment system, it is a foundational pillar in India's journey towards a fully empowered, digitally enabled economy. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.